Which funding option is best for your business? Hi, my name is James Murray and I've got a finance brokerage in Stamford, Lincolnshire, and I help businesses with their growth plans. Now, if you've not watched any of my videos before, the general idea is to help you with your plans, but not necessarily always look to take on debt. Now, this might sound a bit funny coming from a finance broker because you'll think, well, I've got a vested interest in trying to sell you finance. And I'll never profess that I'm completely objective, I can't be. But I'd like to think that one of the USPs with my offering is that I don't actually try and push you into taking debt, and I will try and be the most objective I can be and offer a more holistic approach, giving you more funding solutions, even if they're not something that I directly offer. And the reason I mention that is that today I'm going to share with you some of the funding options that I speak to my clients about, the different types of funding that help them get the business to where it needs to go. Different businesses have different problems. Sometimes you hit a working capital wall. Sometimes you can't get to that next phase of growth because you're either over trading because you've taken on too many contracts and you can't cash flow that next stage. And sometimes it's just the fact that you need money to help grow your team. You might need to invest in infrastructure. You might need to have cash to be able to pay for recruitment costs or IT infrastructure. There's many different things that businesses come up against where they need more money. And it might be that you're at the very start of your business journey, or it might be that you have a 10-year trading business and you're looking to diversify. And these are all the conversations I have. Again, as a finance broker, I'm quite generalist with my approach. I work with some very well-established multi-million pound turnover businesses and some that are turning over hundreds of thousands. So today, I'm going to really help you. I've identified 8 different products that I talk to clients about. Now, that might mean there might be further options available out there for you, but these are probably the top 8 that I speak to my clients about. And hopefully by the end of this video, you'll have a full understanding of the different types of products that are available to you. Some of them might be more relevant than others, but stay around to the end so you can see and evaluate that for yourself. Let's start with bootstrapping. Now, the term bootstrapping originated from the idea of pulling yourself up from your own bootstraps, a near impossible task. And some people might think that that's the same case with starting your own business with your own funds. It can be really challenging, but there's a lot of benefits in putting your own capital into financing your startup business or injecting that money into an already established business. It means you've got full control, but there is obviously the risk of using your own personal money to do that. Now, from a finance perspective, when you are looking to bootstrap, it really does look good from a lender's perspective that the director of that business has invested any of their own capital into the company. Now, some of the things you need to be careful of is if you're looking to get a personal loan. Some people then look to get a personal loan, which again, they might then use that fund to start a business. Now, officially, you're not really meant to do that with a personal loan. The idea of a personal loan is to use it for personal purposes. I'm not saying that people don't end up using it, but you need to be really careful on that front. But that might also be considered bootstrapping. If you are looking to take up a startup loan, there is also the government startup loan scheme. This is actually a personal loan, but for business loan purposes. And I believe it's one of the only ones available out there. The good thing with it is it's a fixed rate of interest. At time of recording, I think it's 6% annually, and you get some support from the government, but it is capped up to £25,000. But if you're at the early stages, bootstrapping is a great idea. And it also shows that you've got some of your own energy into that business, that you believe in that business, and that as you grow it, and if you do then take on investors or go through some of the other options I'm about to go through, that you can then have that origination of that money will really help you attract investors or get debt further down the line. Next, I want to talk to you about invoice finance. So that's number 2. Invoice finance is quite a complicated subject, and I'm not going to use this video to go into the absolute detail of it. But essentially what it is it's where you're borrowing money on unpaid invoices. Now, this is quite common when you have a business that is working with large organizations that might have long payment terms. So let's use, for example, a fruit and veg wholesaler. They may have sold fruit and veg into one of the high street supermarkets, but because that supermarket has got strong buying power, they may pay X amount, but pay it after 60 or 90 days. And what you can do is you can fund on the back of their credit score. So the good thing with invoice finance is you don't necessarily need to have been trading that long. You just need to have good contracts in place and a debtor book that is filling up. Now, essentially how it works, and there's different types of invoice finance. There's invoice discounting, invoice factoring, and there's selective invoice financing, which is where you select individual ones. Now, these different variations all work on the same principle, which is where you are borrowing on the invoice you have set out. So let's say you've invoiced a supermarket for £10,000 worth of goods, but you're not going to get that money for another 90 days. What would happen is the invoice finance company would run credit checks on the debtor, in this case the supermarket, and then they would give you maybe 85–90%, so you'd get £9,000 of that money on the day you raise the invoice. And then their fee is taken out of the remaining amount when you get paid it in the 90 days. Typically, just as a rough figure, don't quote me on this, it might be around about 5% of your invoice. Now, what I speak to clients about with this strategy is it might be that you increase your prices by that amount to cover the costs. And in some routes as well, some of the invoice finance facilities will also do all of the chasing for you as well. So that might be another cost you can save on. You need to be really careful with invoice finance because effectively you're getting that money up front, which is great. It means you can cash flow operations, but it does mean that you are still using money that's borrowed. So if that debt goes bad, you might still be liable for that amount. There's things like bad debt protection, but that's a whole nother subject. So if that sounds like it might be something of interest to you and you have a B2B business, so that's business to business, it doesn't really work if you've got business to consumer. So if you're selling a consumer product, then I would recommend doing some more research on invoice finance and looking into it. But as I said, it's definitely something worth considering, but it can be, well, I call it a bit of an umbilical cord. Once you go into it, it's really hard to then leave it afterwards. Okay, the next one is working capital facilities. So when I talk about working capital facilities, I'm talking about things like overdrafts or flexible credit lines. Now, these sort of things are really good for immediate cash, but they are limited. And also the banks, I mean, I don't know the exact figures, but banks have reduced overdrafts facilities over the last 20 years significantly. I don't know the exact stats, but I think it's tenfold the amount it's been reduced. Now, this means that there's less working capital facilities out there for people. Now, that means challenger banks have come in and offered these flexible credit lines. Sometimes you might be able to take a £40,000 credit line, you pay it down. Now, the problem with these they are normally short-term solutions, so they can be quite expensive. But if you are just dipping in and dipping out and you're happy to pay the service fee, whatever that is at the time, they can provide a bit of a cushion for you in your business, helps you sleep at night, and you know that you've got that extra support if things go wrong very quickly, an invoice doesn't come in and it's not going to, and you've got payroll to pay on the Friday, but you know the invoice is going to come in on the Monday or the Tuesday. For that quick fix, those sort of things can work really well. And I'd say it doesn't hurt sometimes to have those sitting there in the background if it is responsibly managed and that you're looking after that, after your financial management. The next one I want to talk to you about is equity, selling equity or getting an investor on board. Now, this is a big subject I talk to with clients. Now, the problem with bringing on an investor is it can mean that you lose some of the control in your business. It also might mean that you have to change the direction and your vision that you have for the business. Each circumstance is different, so it does depend very, very much on the type of business you've got and the type of business you're trying to build. Now, I'd often find when people are looking for an investor to look at that route when you are not, when debt maybe isn't an option, or if you're looking for large sums or you're looking for mentorship and support. So a lot of venture capital companies will have infrastructures and systems in place to help you get business from A to Z. However, you do just need to know what you're getting into. Sometimes in the long run, taking on selling equity in your business could cost you 10 times the amount it would cost you to take on a standard loan or usual debt. Now, sometimes an investor can be a good option if you have a business model that might be a bit shaky. You might have bad credit history. You might not have put too much of, you might not have a business that has got any assets in it. It might just be an idea. It might be a fintech business. It might be a SaaS company. It could be anything where you have got an idea that needs a big investment that's really hard to attach any sort of finance to. Now, there's different ways to raise this type of thing for venture capital or angel investors, and it's probably time for that in another video. But it's definitely something worth considering with a particular type of business. But it's not something that I would necessarily recommend if you've got a strong business. You just need a bit of extra capital to help grow your business to go to the next stage. You've already got a management team in place. You've already got a business plan that's working nicely. You just need an extra bit of money. Sometimes taking in an investor could be a more expensive route in the long term. As an alternative to that, maybe think of taking on a non-executive director on an additional salary, or look at maybe doing share options or having a sellout option at certain points. So there's lots of different circumstances on that, and maybe I'll do another video on investors and selling equity in the business on another video. Okay, this next one, I've got a bit of a bee in my bonnet on this, because short-term loans are something that are getting offered to businesses left, right and centre. You've probably had an email this week from a finance company offering you a short-term loan. Now, I'd even call these payday loans. Now, payday loans are a term that people probably know in the personal loan section, but businesses are being offered these all the time, and sometimes they are not appropriate for your business. Now, I'm not saying that short-term loans that you can get via fintech companies very quickly, very easily, aren't sometimes an appropriate option for your business. But my answer to that would always be to look at all other options first. With any short-term loan facility, what you will traditionally find is that they are very, very expensive. Mainly they're used as a sticking plaster, so they really shouldn't be used for long-term strategies or for anything where you are looking to invest in a bigger opportunity. Now, if you've got a quick win, a short investment opportunity where you can buy something, there's a clear return on investment, that's fine. But all I would say is just have a look at the costs first and make sure you explore other options. The other things with these payday loans as well is you can go down a bit of a rabbit hole and end up with a product that you don't really think is suitable. You can very easily, and the way in which they sort of offer these products is very quick, very easy. Click a few links, throw a few details in. But getting this type of finance, it shouldn't be treated like personal car insurance on a comparison site. These type of finance agreements are there and they're very easy to use, and I have provided them myself to clients, but as a last resort. And we've always done a bit of strategy and worked through a cash flow forecast to work out how the client can move on from using these facilities. So if you are looking at a short-term loan, definitely come and speak to me, speak to a finance broker that you can trust, and just get an objective opinion. And I would always speak to them first as well, because if you go to some of these lenders straight away, they also have not whole of market, but they have a wider market, and they'll put your application out to other lenders, which might then mean that when another broker gets that application, their hands are tied with which lenders they can go to. And there might be more of a story there, and there might be something where you need to speak to an expert and get an intrinsic understanding of the challenges that your business is having. And a lot of the time with what I do, when I speak to underwriters about getting debt into companies, they really want the story, they want to understand that. So you need to really believe that the broker that you're working with understands your business and that they can relay that message to an underwriter and gather all the appropriate information. On a similar subject to short-term loans, we have longer-term loans. I'm much happier in this space. These sort of loans I'm going to touch on first are unsecured loans. So we're talking purely about unsecured loans where they're not attached to an asset. Now, they might still be attached to what we call a personal guarantee. In fact, most unsecured loans still have directors' guarantees attached to them. That's a conversation for another day as well, but that's just a fact. Now, unsecured loans are much more difficult to get. So if you just listen to the previous part about short-term loans, the reason that those are popular is they're easier to get. You don't always have to be a homeowner. You don't always have to have a strong balance sheet or a long trading history or be incredibly profitable. Whereas with long-term loans, we are looking, and when I say long-term, we're talking about 24 to 60 months, sometimes 72 months, so 6 years. And those sort of loans, we're looking for much more infrastructure. We're looking for the fact that the business has maybe been trading for a couple of years, that there is a clear path to repaying that, so what we call serviceability. Ultimately, would you lend that money to that business yourself? That's always the question I speak to my clients about. If you were an investor, would you put money into that business? If the answer is yes, and there's some element of good credit history in the background and profitable trading, there's a good chance you can get a long-term unsecured loan. Now, the benefit of this is it gives you a lot of accessibility to use those funds and deploy them in any way in which you want. So you could invest that into staff, you can invest that into infrastructure, purchasing all types of things. It could be for working capital, it could be for different growth options. Different funders have different requirements, and that's again why it's worth speaking to a broker, because they will sort of pigeonhole you to the most appropriate funder that is happy with your type of use of using those funds. Now, one thing to be aware of on this is that most of the funders for unsecured lending, they do like the directors behind the business to have some credit worth themselves as well. Statistically, and it's not a prejudice on homeowners, but the reason that brokers like myself and banks ask for you to be a homeowner is statistically, homeowners have a better record of repaying the debts that they have on their loans. So it's not a fact that you don't necessarily always your equity position. However, if you have a strong equity position in your home, then that will also help as well. But homeowners are typically more likely to get larger loans and better terms. I don't make the rules, it's just the way it is. Now, that also feeds in and under the same subject of a thing called the GGS loan, which is the Growth Guarantee Scheme. So this was replaced the Recovery Loan Scheme. So GGS loans are available through different lenders. So some lenders offer this, some don't. It's backed by the British Business Bank, and it gives 70% security on the loan to the bank. So the bank have a little bit more flexibility in their normal credit underwrite. So they will lend to a slightly more risky customer, but it doesn't mean that it's open to everyone. You still have to qualify, and it doesn't also mean that you necessarily get a lower price either. I think people think because it's a government-backed scheme that you're going to get a lower price through a GGS loan. That's not the case. And again, that's why it's always worth speaking to a broker that can tailor these different options and give you options. So we've got a GGS loan here, which is giving you a little bit more security as a director. The PGs are watered down slightly, so your primary residence can't be included. But it might be slightly more expensive than this option over here, which has more security. So unsecured loans are a really good option, but again, I still have the same principle: work through a cash flow forecast, work how that money can get to work for you. Whenever you're taking money, whenever you're taking debt, make the money work for you. You are ultimately paying interest on it, so you need to make sure that it's going to be activated in a way that's going to be beneficial to you and your business. Moving on from unsecured finance, we're now talking about secured finance. So we're talking things like asset finance, commercial mortgages, anything where the finance is secured against an asset. Now, the reason I've done it in this order is we've gone from unsecured loans where you will be limited to a certain amount that you can take and a certain credit rating, because it's what we call balance sheet lending. We're working mainly on the accounts of the business and the directors, because that's the only thing that we can really evaluate. With asset-based lending, there's another thing we're adding into this, which is asset security. So let's just say you're buying some machinery for your business. That machinery has an intrinsic value. And what happens is the finance company attaches an interest to that asset. And it means that if you don't pay it back, if you don't pay your loan, they can effectively come and take that asset away and realize the goods and sell them and recoup some of their money. And that means that there's a lot more flexibility in asset finance. It gives you a lot more scope to borrow money, but it goes beyond just buying something. You may already have what we call unencumbered assets lying around, either personally or in your business. By unencumbered, I mean they don't have any debt attached to them already. So this might be that you've purchased vans over the years and they're sitting there and they're not working for you. So we could raise finance against them if you've reached a cap on your unsecured lending limit, or if we couldn't get you unsecured finance. Sometimes also the rates can actually be better on asset finance as well. So there's a whole scope of asset finance products available. I'd recommend you go to my website, jamesmurrayfinance.co.uk, and I talk about all of these things. Look at my other videos and I'll explain more on asset finance. But yes, asset finance is definitely a big one. So if you're ever investing in something, there's a good chance you maybe could attach finance to it. And it doesn't always have to be a van or a piece of machinery. It could be anything from lighting to a mezzanine flooring. It could be all sorts of things. And finally, the bit you've all been waiting for, the 8th wonder of the world, if that's a thing, I don't know. But maybe this is, maybe it's a new thing. Smart solutions. So again, as I said at the start, I'm a finance broker. I have a vested interest in you taking out debt, but I really like to help businesses on a more holistic approach. I like to help you and make sure that the business is going to be there for the next 5, 10, 15 years. And that doesn't always involve taking debt. Sometimes there's other options available to you that you can look at that might be more beneficial at this time. I do also practice this as well. I've actually done an article recently, which is 17 things to do before getting finance. You can see that on my website, on my blog posts. Again, go to jamesmurrayfinance.co.uk to see that. I'll put a link in the description. But there's plenty of other things you can do instead of getting debt. And have you actually explored all of these options? Have you explored, instead of taking on investors, maybe doing a joint venture with somebody, getting an investor and just doing a single project with an individual? Have you looked at your supplier terms with your own suppliers? Are you paying them immediately, but you're not getting paid for 90 days? Well, could you extend the terms in which you pay? And that might stretch that working capital gap that you've got. There's other things like grants as well. Speak to your local councils. There's normally a business advisor within each. Contact them and they'll talk you through any grants that might be available. I know in my area at the moment, there's one where you can take up to £1,000 as long as you're investing £300 into it, something like that anyway. So there's lots of different grants available, and obviously some much larger scale ones if you're investing in technology or things that are going to drive growth in the local area as well. Then there's things like taking deposits earlier. Now, if you've got a business where you've got a project, let's say in construction, and it's going to be a 10-week project, but you're only taking 10% up front, maybe consider taking 50% up front. That can massively change the way in which your cash flow operations work. And it might mean that you don't need to take any debt, or at least maybe a less significant amount of debt in which you'll be paying interest on. So I hope that really gives you a bit more of a perspective on the different types of ways in which you can get cash into your business. Now, I'm sure there's other ones out there, and I'd really love to hear in the comments anything that you've got to add to that, anything that you think that I've missed in here. I'm sure there's a couple, and start a conversation about it. As I said, I'm not here to preach to you or tell you what you should or shouldn't do, just give you more options and give you a bit more perspective on the different types of funding options available, instead of just going for the quick win on a comparison type finance application. If you'd like to find out more about this sort of thing, I've got a newsletter on my website, jamesmurrayfinance.co.uk. There's lots of resources on there where you can download cash flow forecasts, and there's a magazine as well, which I've recently published, which is a completely free business magazine, which you can download. If you message me directly, I'll be happy to answer any questions. I do not charge a fee for consultation, so we're always happy to have a conversation and talk through your business plans. So if some of the subjects I've talked on this video have struck a chord with you, or something that you want to discuss in more detail, particularly if it's around raising finance in your business, then I'll be more than happy to help. Thanks for watching, please subscribe, and I'll catch you on the next one.